In 2008, Lehman Brothers had $639 billion in assets. 3 weeks later, it had zero. In 1929, the stock market erased 90% of its value in less than 4 years. In 2022, a cryptocurrency exchange called FTX went from $32 billion to bankruptcy in 72 hours. Different decades, different technologies, different regulations, but the same rule broke them all. And it's not greed, it's not fraud, it's not even complexity. It's something simpler, something mathematical, something that's baked into the architecture of almost every financial system ever built. Once you see it, you can't unsee it. And the uncomfortable part? It's happening again right now. Let's start with a number, 10. Not because it's special, but because it makes the math clean. Imagine you walk into a bank and deposit $10,000. You put it in a checking account. It's yours. It's safe. The bank promises you can withdraw at any time. Now, here's the question. What does the bank do with your money? You probably think they put it in a vault. Maybe they invest some of it. Maybe they keep most of it ready in case you need it back. Wrong. They lend out $9,000 of it immediately. To someone buying a car or a house or starting a business, the bank keeps $1,000, the legal minimum reserve requirement in many systems, and the rest disappears into the economy. But here's the trick. Your account still says $10,000. You didn't lose anything. You can still spend that money. Write a check, swipe your card, transfer it. As far as you're concerned, it's sitting there, but it's not. 90% of it is gone. Now let's follow that $9,000. The person who borrowed it uses it to buy something, let's say a car. The car dealer deposits that $9,000 into their bank. And what does their bank do? The exact same thing. They lend out 90% of it. $8,100 goes back out into the economy. The dealer's account says $9,000, but most of it is already gone. This process repeats. Each time money gets deposited, most of it gets loaned back out. Economists call this fractional reserve banking. And here's the result. Your original $10,000 has now created almost $90,000 of total money in the system through loans, from 10 to 90. That's not a trick. That's not illegal. That's how the system is designed to work. So what's the problem? The problem is that everyone believes their money is real and available. You believe your $10,000 is in the bank. The car dealer believes their $9,000 is in the bank. Every person down the chain believes their money exists as cash, ready to be withdrawn, but it doesn't. Most of it is just a number in a computer, a promise, an IOU, backed by another IOU, backed by another IOU. The whole thing works beautifully under one condition, that most people don't ask for their money at the same time. Think about that. The system is designed on the assumption that you won't use your money. As long as the flow is balanced, as long as new deposits come in while old debts get repaid, the illusion holds. The machine hums along. Credit expands, businesses grow, people buy homes. But it only takes one crack, one moment where more people want their money than the bank has in reserve. And that's when the math stops working. Let's go back to 1929. In the years leading up to the crash, everyone was making money in the stock market. Farmers, teachers, shoeshine boys. People were buying stocks with borrowed money, something called margin loans. You could put down 10% and borrow the other 90% from your broker. Sound familiar? Stock prices kept climbing. Everyone felt rich. Banks were lending aggressively because the collateral, the stocks themselves, kept going up in value. Then, in October, prices started to fall. Not collapse, just fall, a few percentage points. But that was enough. People who bought on margin got nervous. They tried to sell to cover their loans. More selling pushed prices lower. Brokers demanded more cash to cover the shrinking collateral. And then people did something the system wasn't designed for. They went to the bank to pull out their money. Not because the banks had done anything wrong, just because they needed cash. But the banks didn't have it. Remember, they'd lent out 90%. Their money was tied up in loans to businesses, to margin investors, to other banks. When depositors showed up asking for their funds, banks couldn't pay. So they failed. More than 9,000 banks collapsed in the years after 1929. The money didn't just disappear into the ether. It vanished because it never existed in the first place. It was a promise, built on a promise, built on a promise. And when one promise broke, the whole chain snapped. Here's the rule. Liquidity is an illusion that only works when you don't need it. Liquidity means access to cash, the ability to turn your assets, your investments, your account balance into actual spendable money. In calm times, liquidity feels infinite. You can sell stocks in seconds, withdraw from your bank instantly, borrow against your house. But liquidity isn't a feature of the asset. It's a function of the crowd. It only exists because other people are willing to buy what you're selling, or because the bank assumes you won't all show up at once. The moment everyone wants out at the same time, liquidity disappears. Your stocks are worth nothing if no one will buy them. Your bank balance is meaningless if the bank has no cash. Your house is just a building if no one can get a mortgage. This is what breaks the system. Not bad investments, not corrupt CEOs, not even panic. It's the mathematical reality that in a fractional reserve world, there is never enough liquid money to cover everyone's claims at once. The system is built to be solvent, meaning assets exceed liabilities on paper, but it's not built to be liquid, meaning it can't turn those assets into cash fast enough when everyone asks at the same time. And every financial crisis in history is just a different version of this same problem. You might be thinking, okay, but we fixed this, right? We have deposit insurance. We have central banks. We have regulators stress testing banks to make sure they can handle withdrawals. And that's true. The system has more guardrails than it did in 1929, but the rule hasn't changed. It's just moved. In 2008, the crisis wasn't in the bank's checking accounts. It was in the shadow banking system. Investment banks like Lehman Brothers were borrowing short-term money to buy long-term assets, mostly mortgage-backed securities. Same structure. Borrow liquid money, invest it in illiquid assets, assume you can always roll over the debt. It worked until it didn't. When the value of those mortgage securities fell, lenders stopped rolling over Lehman's short-term loans. Lehman needed cash. It couldn't sell the assets fast enough. Liquidity vanished. $639 billion in assets, gone in weeks. In 2022, FTX had billions of dollars of customer deposits. Those deposits were supposed to be liquid, available for withdrawal anytime. But FTX had lent them out to its sister trading firm, Alameda Research, which used them to make illiquid bets on startups and tokens. When customers started asking for their money back, FTX couldn't pay. The liquidity wasn't there. Same rule, different decade. Even now in 2024 and beyond, we're watching this play out in real time with everything from regional banks to stablecoins to treasury markets. Anytime something is marketed as perfectly safe and always accessible, ask yourself, is it actually liquid? Or does it just seem liquid because no one's tried to leave yet? Here's the part no one wants to say out loud. The system isn't broken because of the crashes. The crashes are a feature, not a bug. If you build a financial system on leverage, on lending out more than you hold, on the assumption that not everyone will ask for their money at once, then you are mathematically guaranteeing that eventually someone will. And when they do, the system has to reset. That reset is the crash. And it's not a failure of regulation or oversight or human judgment, though those things matter. It's the inevitable result of a system designed to create growth by multiplying claims on money that doesn't exist in liquid form. You can delay it. You can make the cycles longer. Central banks can step in and provide emergency liquidity, which is just a fancy way of saying they print money or lend it to banks so the banks don't collapse. But you can't eliminate the risk, because the risk is the system itself. Every dollar of economic growth created through credit is also a dollar of potential instability. The more leverage in the system, the more efficient it is during good times, and the more catastrophic it is when the music stops. And here's the kicker. We've decided collectively that this trade-off is worth it, because the alternative is slower growth, less credit, fewer opportunities, a world where you actually need to have money before you can spend it. We've chosen the casino. We just pretend we haven't. So what does this mean for you? It means the next time someone tells you an investment is safe, ask where the liquidity comes from. It means the next time a bank or platform or protocol promises you instant access to your funds, ask what happens if everyone wants access at the same time. It means understanding that the money in your account, the value of your portfolio, the equity in your home, all of it is only as real as the system's ability to convert it to cash when you need it. And that ability is always contingent on other people not needing the same thing. The rule is simple. There's never enough liquid money to cover all the claims. Not in 1929, not in 2008, Not now. The system works by convincing you that your claim is special, that you'll be able to get out before everyone else, that the door is wide enough for everyone. But it's not. It never has been. And the people who understand this rule don't try to fix the system. They just make sure they're closer to the exit. So here's the question you should be asking. When the next liquidity crisis hits, and it will, where will you be standing? Near the vault or at the back of the line? Because in the end, the only rule that matters is the one no one wants to admit. The money was never really there to begin with.